Hi, my name's Shane Hurst. I'm a portfolio manager at ClearBridge Investments in Sydney, and today I'm going to be running through the valuation of infrastructure assets for the 31st of March 2021. So when we discussed valuations last quarter, the market environment was particularly strong. We saw both fiscal and monetary stimulus, positivity around new vaccines and their high efficacy, in particular Pfizer and Moderna, as well as strong equity market returns. For our strategies, strong performance came from renewables in the US and Europe, with the market very much focused on decarbonisation. Electric utilities also performed well, in particular those in South America, and transport infrastructure and pipeline assets also were a standout as they benefited from greater global mobility. Q4 2020 also saw the valuation of renewable companies become stretched, with attractive valuations opening up in areas like US utilities. So turning to slide 3, as we look back on the quarter that was Q1 2021, that was driven by a number of factors. The first was a large fiscal stimulus bill of $1.9 trillion in the US. Global economies continued to perform strongly, led by the US, as we saw increased vaccine rollouts as we move towards a greater reopening of economies around the world. We saw value markets and value stocks tending to outperform defensive markets and defensive stocks. And we also saw global bond yields rise on greater growth and greater inflation expectations. In the US bond yields moved from 0.9% to 1.7%. So frankly, a strong quarter as it relates to markets. If we turn to slide 4, excess returns, which is our measure of valuation by subtracting the cost of equity from our cash flow generated IRR, continue to screen as attractive from both a regional and from a sector perspective. If you turn to slide 5, the dispersion in earnings estimates continues and really is linked to the mobility of the sector or asset you're investing in. Obviously, it is far harder to forecast short-term earnings as it relates to user pay assets, your transport infrastructure assets like your airports, your rail and your roads, rather than your utilities. And you're certainly seeing that in the dispersion of earnings estimates for those different assets. Longer term, though, user pay, roads, airports, rail and port assets provide crucial infrastructure for the countries they are located in. So diving into a little bit more detail on slide 23. So you can see there high airport and commuter rail multiples, and they are not really reflecting expensive assets. What they actually are reflecting is short-term earnings, which are limited, and a lack of transparency around future traffic recovery. So just as a reminder, traffic disruption itself is nothing new in airports or commuter rail. We've seen other viruses and downturns in the past often cause volatility in travel. What's obviously important, though, is longer term, these are strategic assets. And if you look through the noise and pick these up at very attractive valuations, they will provide very good returns. When we consider US rail infrastructure and road infrastructure, transport infrastructure on this chart, it actually tells a little bit of a different story. The continued easing of lockdowns over the quarter really have driven a meaningful recovery in road and rail traffic, and as such, you are seeing improved long-run visibility in these sectors. Turning to slide 25, really it tells you a very similar picture. A lack of transparency caused by lockdowns has also impacted dividends. The transparency of future dividends in some transport infrastructure assets, namely roads, has improved, whilst the transparency in most airport dividends is very much limited. Turning back to slide 22, valuations in certain renewables assets, as we spoke about earlier, have become stretched and really that started to occur late Q4 2020 and into Q1 2021. What we saw there were longer term growth expectations really brought forward into firm market valuations for these assets. For utilities, EV to EBITDA multiples continue to move sideways. Really nothing's changed. Transparency continues to be high with these businesses. Clearly they are essential service in nature, have particularly good regulators, and socially are crucial to the communities that they operate in. Listed infrastructure, really does provide attractive valuations when compared to unlisted infrastructure. And we've seen a number of transactions during the last quarter which have exhibited that. Importantly, it also provides added liquidity and a greater opportunity set than unlisted infrastructure. So if we look at a strategy level, performance has lagged the very strong broader market performance during the quarter. On slide 9, looking at the value strategy where there is more of an even balance of return from capital and income. Look, during the quarter, we continued to increase our infrastructure leverage to the global recovery, in particular US rail, roads in Europe, and energy infrastructure in North America. This was funded primarily by selling renewables in the US and in Europe. If you turn to slide 10, the income strategy where we are targeting a dividend yield of 5% through the cycle with some capital upside continued to also increase aggressively into infrastructure leverage to the global recovery. In particular, we increased our conviction into European roads, rail in Europe, airports in Australia, and energy infrastructure in Canada. We also increased our US utility exposure on attractive valuations and some really key catalysts which will likely play out over the coming quarters. This was funded by profit taking also in North American contracted renewables, but we also took advantage of high valuations in South American utilities and UK water exposures to fund that trade into more GDP sensitive companies and infrastructure that's leveraged to the global recovery. So taking you back to the key takeaways and just to summarise on slide 3, in terms of attractive opportunities, there are a number within our strategies and across our universe. The first is a global recovery as we see increased mobility supporting transport and infrastructure assets, decarbonisation globally, benefiting not just our utilities and renewables exposure, but also infrastructure. The 5G narrative continues to strengthen and support our tower exposures and valuations. And utilities, especially in the US, provide distinct idiosyncratic drivers and very attractive valuations that make them very interesting places to invest currently. So in summary, there continues to be outstanding opportunities globally with dislocated markets allowing the strategies to position very well for the future. Thank you very much.